Okay, imagine for a second you're standing next to an elephant. It's massive. It's powerful.
Right.
It commands total respect just by being there. It's got thick skin, and it moves with this heavy, deliberate, slow-motion pace.
You certainly don't expect it to suddenly break into a sprint.
No. Or start leaping over hurdles like a gazelle.
That is quite the visual to start with. An aerodynamic elephant.
Well, that's exactly what we're talking about today. We're looking at a financial empire with a balance sheet larger than the GDP of most countries. But the real story here isn't the size.
No, it's not.
It's the fact that this giant Mitsubishi UFJ Financial Group, or MUFG, has spent the last 2 years absolutely reinventing itself.
It really has. If you haven't looked at MUFG since, say, 2023, you might not even recognize the internal engine anymore. It's a completely different animal.
Exactly. I'm your host for the Japan Stock Podcast, and today we're doing a deep dive into the boardroom strategy of Japan's largest bank. We're recording this in January 2026, looking back at a pivotal stack of, strategy briefings and financial reports from 2021 all the way through the end of 2025.
And our mission today is to decode how this very traditional Japanese lender transformed into a digital and Asian powerhouse. We're going to look past the teller window and see how they're actually making money in this new era.
So let's start with the basics for anyone who just knows that red logo on the street corner. We call it a bank, but in their documents, they keep referring to the group. It's a bit more than just a place to store cash, isn't it?
Well, it's a behemoth. You have to remember MUFG isn't just one commercial bank. It's a comprehensive financial ecosystem. You have the bank, the trust bank, the securities arm.
Right.
It was all formed back in 2005 through a massive merger. The idea was to create this sum-of-the-parts entity that was designed to be the main bank for corporate Japan.
The main bank system. That's a very specific Japanese concept, right?
Yeah, it is. It implies a relationship that goes way beyond just lending. The bank is a partner, a shareholder, a safety net. And historically, MUFG was the rock.
The rock.
Reliable, massive, and let's be honest, historically a little bit conservative.
Conservative feels like a polite way to put it. I think for a long time, the perception was that they were just chasing volume, just getting bigger for the sake of being big.
That was the narrative. But if you look at the strategy reviews from 2024 and especially 2025, the tone shifted completely. They celebrated their 20th anniversary last year, not by looking back, but by aggressively rebranding and restructuring. They stopped asking, how big can we get?
And started asking, how fast can we move?
Exactly. I saw a metaphor in one of the analyst notes.
The supertanker.
Yeah, the supertanker that upgraded its engine while still at sea. I think that's accurate. They managed to shift from a volume-based game to a quality-based game, without sinking the ship.
So let's trace that arc. How did we get from the rock to this sprinting elephant? Because banks don't usually change direction this quickly.
To understand the sprint, you have to understand where they started. Go back to the early 2000s. The entire Japanese banking sector was fighting what they called the three excesses.
The three excesses.
Debt, capacity, and labor. Essentially, they had too many bad loans, too many physical branches, and too many employees.
A purely defensive game.
Totally. Then, in the 2010s, once they stabilized, they went on a shopping spree. They bought assets everywhere. Union Bank in the U.S., partner banks in Asia.
So that was the volume phase, buying revenue because the domestic market in Japan was shrinking and aging.
Exactly. But the real plot twist happens between 2021 and 2025. This is what the documents call the business model transformation.
And looking at the timeline, there seemed to be two massive signals that proved they were serious. The first one, which I remember being quite controversial, was the sale of MUFG Union Bank.
The U.S. Bancorp. That was the turning point. That was the moment the market realized they weren't sentimental about their assets.
But help me understand the logic there. Why sell a guaranteed foothold in the U.S. retail market? Everyone wants to be in the U.S.
Everyone wants to be in the U.S. profitably. Union Bank was heavy on regulation, heavy on costs. It was a low-growth retail business. By selling it, MUFG freed up a massive amount of capital. Billions of dollars.
Yeah.
They essentially traded a mediocre retail presence in America for the cash and flexibility to go hunting for higher returns elsewhere.
So they cut off a heavy limb to run faster.
Perfectly put. And that elsewhere turned out to be digital, right here in Japan. This brings us to the second massive signal, the moves they made in 2024 and 2025 regarding domestic wealth.
Right, this is where it gets fascinating. In January 2025, they made Wealth Navi a wholly owned subsidiary.
Yep.
And then, They rebranded their online brokerage, Okabacom, to Mitsubishi UFJ eSmart Securities.
eSmart Securities sounds like marketing fluff, but that rebranding was a declaration of war.
War on what?
War on cash. For decades, Japanese banks were in the business of holding money. You put your savings in, they hold it, they pay you near zero interest.
The new MUFG is in the business of moving money.
Exactly, moving those household savings into investment products. Japan has this massive pool of dormant cash sitting in savings accounts, trillions of yen. MUFG wants to move that cash into stocks, bonds, and mutual funds, capturing fees every step of the way.
So WealthNavi and eSmart Securities are the pipelines for that movement.
They are the pipelines. They stopped trying to be a storage unit and started trying to be a logistics company for capital.
That's a brilliant way to put it.
Yeah.
And it's not just happening in Japan. When you look at their overseas operations, you see a completely different strategy depending on where you are. A two-speed world.
It is.
So let's unpack that. Let's look at the United States first. If they sold the retail bank, what are they actually doing there now?
They went pure wholesale.
Okay, for the listeners who might not be in finance, can we define wholesale in this context? We're not talking about Costco.
No, not Costco. In banking, retail is serving individuals, you and me, checking accounts, credit cards. Wholesale is serving massive corporations and institutional clients.
So in the U.S., MUFG is now effectively a high-end corporate investment bank.
That's right. They aren't trying to issue credit cards to consumers in California anymore. They're lending billions to Fortune 500 companies.
And they aren't doing it alone. The documents keep mentioning Alliance 2.0 with Morgan Stanley.
This is their ace in the hole. You have to remember, MUFG owns a significant chunk of Morgan Stanley.
They bought in during the 2008 financial crisis.
And it turned out to be one of the best investments in banking history. And this Alliance 2.0 means they've deepened that relationship to a point where they're sharing deal flow.
Deal flow.
Imagine a massive U.S. tech company needs to merge with a competitor. That deal needs two things, advice and cash.
Okay.
Morgan Stanley provides the M&A advisory, the strategy. MUFG provides the balance sheet, the raw cash to finance the deal.
One brings the brains, the other brings the muscle.
It's a powerful combination that few other global banks can match.
It sounds lucrative, but we have to talk about the risks. The U.S. market isn't exactly calm right now.
No, it's a shark tank. You have regulatory constraints that are incredibly tight, but more importantly, looking at 2026, the political landscape is volatile. Policy unpredictability, tariffs, shifts in labor laws, these are real headwinds.
So this is still exposed?
They are. If the U.S. sneezes, that wholesale portfolio catches a cold.
Okay, so that's the West suits, boardrooms, big corporate deals. Now let's fly over to Asia. This feels like a totally different vibe in the documents. They mention an MUFG economic zone.
This is the most surprising insight for me. In Southeast Asia, MUFG isn't just a Japanese bank doing business abroad.
They are the local bank.
Yes, they bought Krungsri in Thailand, Bank Danamon in Indonesia.
Vietnam Bank in Vietnam, Security Bank of the Philippines.
Exactly. They have built a second home market. But in the last 2 years, they layered something new on top. They went heavy into digital.
I saw names like Grab, Home Credit, and Akulaku in the investment portfolio. Grab is the Uber of Southeast Asia, right?
It is, but it's also a financial super app. And Akulaku is huge in digital banking. By investing in these, MUFG is trying to capture the data and the financial flows of millions of young digital native Asians.
Why is that data so valuable to a bank?
Well, think about it. In Japan, MUFG has data on people with bank accounts. In Indonesia or the Philippines, many people don't have traditional bill accounts.
Or they use Grab for everything. Rides, food delivery payments.
Right. So MUFG can use that rideshare data to figure out who is creditworthy. They can underwrite loans based on lifestyle data rather than credit history.
Asia x digital. That's the strategy.
That's it. Combining the trust of a traditional bank with the speed of a fintech.
In looking at the region, we should touch on China briefly. The strategy documents are a bit more cautious there, aren't they?
They are, but they're pragmatic. While the U.S. is about risk management, China is framed around opportunity management. As Chinese companies expand into Southeast Asia, into that MUFG economic zone, MUFG wants to be the bank that facilitates that trade flow. They aren't trying to be a retail bank in Shanghai. They're trying to be the bridge between China and Southeast Asia.
It's almost like they are running three different companies. A high-end investment bank in the U.S., a trade facilitator in China, and a mass-market fintech in Southeast Asia.
And that diversification is key, because we can't ignore the macro environment here, where in 2026, the central banks are moving in opposite directions.
Right. The Bank of Japan has been hiking rates, while the U.S. Fed has been cutting. That's a huge change. How does that impact a giant like this?
It's a massive tailwind for their domestic business. When you have a deposit base as massive as MUFG's, we're talking hundreds of trillions of yen. Even a small tick up in domestic interest rates generates billions in net interest income.
So simply put, they pay depositors a tiny bit more, but they charge borrowers a lot more.
Exactly. The spread widens. That's pure profit dropping to the bottom line.
But the U.S. rate cuts work the other way.
They do. It compresses their margins on dollar-denominated lending. But overall, for a Japanese bank, the return of positive yen interest rates is like finally finding water in the desert after 20 years.
Okay, let's get into the engine room. We've talked about the geography, but I want to understand the how. How does this complex machine actually generate profit? Let's uncover the hidden logic behind the numbers.
Sure. If you look closely at the earnings reports, there are three main drivers that really determine the company's future. The first one is a concept called O&D, origination and distribution.
Sounds like factory talk.
In a way, it is. The old banking model was, I lend you money, I hold that loan on my books for 30 years, and I hope you pay me back.
Which clogs up the balance sheet.
Totally. You run out of money to lend because you're holding on to all the risk. It's like a car dealership that never sells the cars, just keeps them on the lot.
Eventually, the lot is full.
Right. The O&D model is different. MUFG lends you money, say, for a massive aviation project, but then they immediately slice that loan up and sell pieces of it to institutional investors, insurance companies, other banks.
So they're originating the deal, taking a fee, and then distributing the risk.
Exactly. They get the fee income, they keep the customer relationship, but they don't have to hold all that risk. This increases what we call asset turnover. It improves their return on equity.
ROE, that's basically the efficiency score, right? How much profit they generate for every dollar of shareholder money.
Precisely. And for years, Japanese banks had terrible ROE. They were sitting on piles of cash doing nothing. This O&D model churns that capital. It turns the bank from a storage facility into a factory.
That explains why they're often top-ranked in global project finance. They're a factory for debt deals.
They're a global debt house. And that connects directly to driver number 2, the wealth management pivot back home in Japan.
We touched on this with WealthNavi, but why is this such a big driver now?
2 reasons. Inflation and friction. For decades, there was deflation, so cash was king. Now, with inflation in Japan, cash is losing value. People need to invest. But it was always difficult, scary, and disconnected from your normal bank account.
And MUFG is trying to remove the friction. I saw something about Money Canvas.
Right, that's their platform strategy. Think of it as a smartphone interface. It connects a regular bank depositor directly to high-margin investment products.
So I open my banking app to check my balance, and right there is a button to invest in a global equity fund.
That's the idea. Make the friction disappear. By fully acquiring their asset management arm and WealthNavi, they control the product and the distribution. They make a fee when you buy it, and they make a fee for managing it.
So if driver 1 is selling debt to global investors, and driver 2 is selling investments to Japanese households,
right.
What's driver 3?
Driver 3 is the global CIB corporate and investment banking amplified by that Morgan Stanley alliance. We mentioned it, but it's crucial to understand the scale. MUFG isn't just lending money. They are advising on strategy.
There was a stat that caught my eye. They're often ranked number 1 in syndicated loans globally.
That is a staggering statistic for a Japanese bank. It puts them in the same league as the Wall Street giants like JP Morgan or Citi.
And syndicated loan just means a loan so big that a group of banks has to chip in together.
Yes. And being the lead arranger on those deals means you get the biggest fees and the most prestige. It validates that their wholesale strategy in the U.S. wasn't a retreat. It was a doubling down on where they had an advantage.
It feels like they finally figured out who they want to be. For a long time, it felt like they wanted to be everything to everyone.
Which is the classic trap of a conglomerate. Now, they have clear identities, a wealth manager in Japan, a corporate power broker in the U.S., and a digital consumer bank in Asia.
And the pieces fit together.
Logically, yes.
So let's talk about what this means for the person holding the stock. Because for a long time, Japanese banks were seen as, well, value traps.
That reputation was well-earned. They hoarded capital just in case. But the 2026 strategy review highlights a very disciplined framework they call the capital triangle.
Sounds like something from a geometry class, but I assume it involves cash.
It's simple but effective. Point 1. Maintain financial soundness. Be safe. Point 2. Invest for growth. That's the money for buying WealthNavi or investing in Grab. Point 3. Return the rest to shareholders.
And the rest has been growing.
Significantly. They've moved to a progressive dividend policy.
Which means?
It means they aim to increase dividends over time and commit to not cutting them. It's a signal of confidence. But the real excitement for investors has been the share buybacks.
And cancellations, right? I saw that. They aren't just buying the shares, they're destroying them.
Correct. Share cancellation reduces the total number of shares in existence.
So if I own a slice of the pizza and they remove 2 slices from the box, my slice represents a bigger percentage of the whole.
Exactly. It automatically boosts earnings per share and ROE. It's a direct way of telling shareholders, we value your slice of the pie.
It feels like a very modern, almost Western approach to capital management.
It is. The expert view is that MUFG has graduated from being a Japanese bank to being a global financial institution headquartered in Japan. The governance and capital discipline look much more like what you'd expect from a New York or London-based firm.
So we've got the elephant sprinting, we've got the O&D model churning out fees, we've got a digital empire in Asia. It sounds like a victory lap, but surely there are risks.
There are always risks. The biggest one isn't financial, it's execution. They have bought all these shiny new toys. WealthNavi, the stake and grab, the partner banks. The hardware is there.
But does the software work?
That's the question. Can a 370-year-old Japanese corporate culture truly sync with a nimble Indonesian fintech?
That culture clash must be real. I can't imagine a startup founder in Jakarta loves filling out approval forms for Tokyo headquarters.
Precisely. MUFG is famous for its bureaucracy. It's safe, but it's slow. Digital banking requires speed. If they crush the culture of these companies they bought, the value disappears.
So integration is a danger zone.
Integration and people. And in the U.S., the risk is regulatory and geopolitical. But the biggest variable for the next 3 years is really about that internal wiring. They've built the platform, now they have to make the data flow.
So what does this all mean for us, for the person listening who might be watching the Japanese market?
It means we are watching a test case for the entire Japanese financial sector. If MUFG pulls this off, if they can successfully marry the stability of a megabank with the agility of a fintech, they create a blueprint for how legacy institutions survive in the 21st century.
It's the difference between being a dinosaur and being, well, a sprinting elephant.
A sprinting elephant that knows how to use an app.
I like that. So as we wrap up this deep dive, what is the one question you want our listener to walk away with?
We've talked about their success in buying pieces. My provocative question for the listener is this. MUFG has successfully transformed its business model, but have they transformed their people? You can buy WealthNavi, but can you turn 100,000 traditional bankers who spent their careers stamping forms into digital advisors?
That's a fascinating thought. The next growth curve doesn't depend on the balance sheet anymore. It depends on the human capital adapting to this new reality.
Exactly. You can change the strategy deck overnight. Changing the DNA takes a generation. That is the variable I'm watching.
Well, that is all the time we have for this deep dive into MUFG. It's been a journey from the 3 excesses to the digital economic zone.
A pleasure to walk through it.
Thanks for listening to the Japan Stock Podcast. Keep an eye on those elephants. They might be moving faster than you think. Catch you next time.